Good morning, good afternoon, good evening, depending on where you are in the world. I'm Nicolas Véron. It's my pleasure to introduce this session of financial statements at the Peterson Institute. I hope you will pardon my slightly unusual background today. It is our great privilege and pleasure today to have Şebnem Kalemli-Özcan and Atsi Sheth to discuss credit and what we've learned really about corporate credit and how it withstood the shock of the pandemic in the last year and a half. I say year and a half because there is a story to this session. The very first session of the financial statement series at the Peterson Institute was in early June 2020. And it was the beginning of this cycle of discovering how corporate credit would react to the shock of the pandemic. And the main speaker was Anne van Praag from Moody's with David Wilcox of the Peterson Institute as a second speaker. So since then, Atsi Sheth has succeeded Anne van Praag as the global head of credit strategy at Moody's. So it's a very nice way of taking an update, and she will be second speaker this time after Şebnem. Şebnem Kalemli-Özcan is the Niall Moskowitz Professor of Economics and Finance at the University of Maryland in College Park near Washington. She holds a BA from Middle East Technical University in Ankara, an MA and PhD in economics from Brown University in Rhode Island. She graduated in 2000. And then she held a number of faculty positions at the University of Houston, at Bilkent University and Koç University in Turkey, at Harvard, and since 2015 in her current position at the University of Maryland. She also has a remarkable experience in policy positions with different fellowships and associations and affiliations, at the European Central Bank, at the World Bank, at the Bank of England, at the International Monetary Fund, the Federal Reserve Board, and advisory bodies of the European Systemic Risk Board in Frankfurt, the Bank for International Settlements, the Federal Reserve Bank of New York, and I'm probably forgetting some. So very impressive range of policy perspectives and also academic as currently co-editor of the Journal of International Economics and the associate editor of the American Economics Review, but also a former associate editor of the Journal of the European Economic Association and the Journal of Development Economics. So as you can see, there is a kind of unique straddling of both functionally between academia and policy, but also geographically between the US, Europe, and emerging economies. And when I say Europe, I should say both the UK and the Eurozone. Atsi Sheth has been global head of credit since earlier this year. She trained at Northwestern University, where she graduated in 1997. She then worked for Moody's in credit policy and sovereign risk in New York. And in the late 2000s, she became chief economist at Reliance Capital in Mumbai, and then came back to Moody's in 2010. So she's worked there in New York, in Singapore, in the sovereign risk group, and since 2016 in the credit strategy group as managing director, and as I said, since earlier this year as global head. With that, Şebnem, over to you.
Thank you very much, Nicolas. It's a pleasure to be here. In my 10 minutes, I'm just going to do a quick overview of these issues. I'm going to use some slides, if you don't mind. Let me share this with you. So, corporate leverage, credit cycles, and growth is a topic dear to my heart, and I have been working pretty much over the last 2 decades. And when COVID shock hit, obviously, it was a great opportunity from a research perspective and policy perspective for myself to apply the insights I learned before COVID to COVID. This is a simple figure of corporate debt to GDP in advanced economies and emerging countries. I would like to take the long view here. This goes back to 2002, as you can see in the slide, and just stops in 2019, right before we entered COVID. Of course, we knew about this huge increase in corporate debt in Euro area countries, but emerging markets, United States, also there. Emerging markets start later, and overall, all countries in the world are going to be suffering from this problem moving forward. And it is important to understand the COVID's impact here. As I said, there are some references on my work, but let me just focus on what we did in terms of applying these insights to COVID. So the thing with COVID is, of course, originally we thought, it's going to be a huge worldwide failure. So we asked that question, what is going to be the effect on firm failures? Now here, an important point is it is very hard to get this data real time. Even in a normal business cycle exit situation, we have to wait 2 years for the actual firm exits to come out. Because it has to go through census and balance sheet reporting. Now with COVID, we had the problem that a lot of countries put a legal ban on filing bankruptcies. For example, Germany, if you have a liquidity shortfall, you go and file for bankruptcy. Germany said, no, you cannot do that. So it is very hard to understand in real-time data what is going on with bankruptcies, firm failures. So we said, let's do a model and try to estimate this counterfactual, then ask what is the cost and effectiveness of the government intervention saving the firms, because obviously firms didn't fail, but why is that? I mean, there was just huge government intervention came through right away in all the countries. Then, of course, we asked, well, okay, maybe we saved too many, maybe we were inefficient, these policies were untargeted, did we waste, did we create something? So these are the questions we asked. We are going to do a simple setup where we are going to look at the cash of the firm and then we estimate the cash flow during COVID and then see if these two is less than firm's expenses, then we are going to say this firm is going to exit. So this is a counterfactual estimate, right? I mean, because we don't have real-time data on 2020 and 2021, see how much we can get from a simple model of firm profit maximization. Firms are just maximizing profit, very simple. We are going to use firm level balance sheet data entering the COVID and that estimate this equation, which is cash flow COVID, that says revenue of the firms in 2018, 2019, hit by the COVID shock. This is going to depend on which sector firm is at, minus the cost of goods sold in 2018, 2019, hit by the COVID shock, minus fixed costs and taxes. And we are going to estimate this equation by taking into account firms can fire workers and going to optimize by minimizing the cost over this choice of labors and materials, given this supply and demand shock at the 4-digit sector level. Here's a figure of our supply and demand shocks. So the color coding on this slide, Nicolas, is that orange sectors are the essential sectors of economy. We do this at a way more granular level, at 4-digit level, but I'm going to show you 2-digit here so you can see it clearly. On the left, you see that supply shocks are very severe for everyone, right? Like the non-essential sectors in black here, like accommodations, food, entertainment, recreation, like minus 0.15 percentage point supply shock. Also essential sectors such as manufacturing or electricity, they get supply shocks. On the right, you get the sector-specific demand shock. And of course, this is relative, right? I mean, this is the story of I don't go to restaurants, but I'm going to order, groceries. And the reason why supply shocks are intense, of course, lockdowns, epidemic, and all that, all these things you already know. Now, given this, the baseline failure rates we estimate is going to be from non-COVID to COVID, an increase of 9 percentage points, regardless of the coverage of the data. If you look at the countries where we have very good coverage of firms and firm balance sheets, like European countries and all countries, because, in the United States, private firms don't report their financial position, which is a big problem for the United States. Nevertheless, we estimate a 9 percentage point increase from a 9% of bankruptcy rate to 18% bankruptcy rate from non-COVID to COVID. This is a counterfactual estimate in the absence of no government intervention and what would have happened at the end of 2020 if governments didn't rush to rescue, okay? There is going to be a lot of heterogeneity across sectors. Of course, sectors, services, and hospitality, the failure rate could have gone up as much as 26 percentage point without the government intervention. Country heterogeneity, same. Countries like Italy, where firms entered the COVID crisis with very weak balance sheets, could have experienced bankruptcy rate increasing up to 15 percentage points. Of course, this didn't happen, right? And in terms of the risk to financial stability, we use data from Belgium, Finland, France, Germany, and Greece, and we show that in spite of these huge bankruptcies could have happened, it didn't happen because of government intervention, and also there isn't a risk to financial sector stability. So we estimate only a minus 2 percentage point decrease in the CET1 ratio, and this is really nothing because you start from an initial ratio of regulatory capital of 14%, and this is thanks to the legacy of 2008-2010 crisis. Okay, I have 5 minutes left, so let me just tell you that if you add a worldwide trade and production network, IO linkages, flexible prices, and then bring the policy support, not much change in terms of the counterfactual estimate, which is what would have happened if policy support didn't come. But of course, the numbers are going to be very interesting when we factor in the policy support. And this is with the supply chain disruption, which is, of course, the number one issue right now. So here are those numbers. Again, now we add all these details to the model, you still will see a 9 percentage point increase in small, medium enterprise failure rate in all the countries. Advanced countries would have been higher, almost 6 percentage points, emerging markets, 13 percentage points. And this is including the IO linkages, supply chain disruptions. That's why it is much higher in emerging markets. Then the policy comes, and what policy does is, of course, in the model, policy is targeted, and you can just, at a very little cost, 0.8% of GDP, you can reduce all the bankruptcies. In real life, what happened is you reduce that counterfactual 9 percentage point bankruptcy rate to 4.3 by dispersing 4% of GDP. This is all countries' number. Advanced countries, 6% of GDP. By the way, this is not the entire fiscal package. That's like 15% of GDP in advanced countries. 6% is policies such as pandemic loans, grants, and rent and tax waivers. That 6% of GDP policy support reduced the counterfactual firm failure rate of 6 percentage point increase in advanced economies to a full offset of minus 0.4, which means advanced economy firms are doing better under COVID. Of course, this didn't happen in emerging markets because the money spent was too little, right? Only 1.9% of GDP. So you go down from 12 to basically 9%. You still reduce, but you don't spend much. You don't reduce much. So this is a story of fiscal space, Nicholas. I mean, advanced countries spending is just like way above emerging markets. And of course, that's the effect of not seeing economy-wide bankruptcies. My final slide is going to be, what about targeting? What about zombification? These policies, of course, were poorly targeted. A program like PPP, United States, put together in 1 week. So you just cannot target like a medical surgery, go and pick firm by firm who is viable or not. But the silver lining is that zombification didn't happen. Only 2% of the funds went to zombies, 13% firms were at risk were zombies. And in 2021, the firms you saved in 2020, if they were all zombies, you would have really see a huge increase in the bankruptcy rate in 2021. That didn't happen. Only 2.6% increase. Why? Because the firms you saved in 2020 are mostly viable. That doesn't mean funds are not wasted.
I have to ask you here, sorry for interrupting, but it's a favorite question of mine. How do you define zombies here?
Yes, zombies, we use the standard definition based on the ICR and then the cash flow. So we look at the last 3 years. So we took an average of the 2016, 2017, 2018. So these are the firms who entered the crisis as zombies, and if you are saving them or not, right? So this says actually when we are entering the COVID crisis, we didn't have that much zombies. So except, of course, there are going to be countries like Italy where you say more zombies, right? I mean, so there is going to be a country heterogeneity for sure. I mean, I didn't mean to hide that. But overall, country firms didn't enter with that weak balance sheet being zombies. So in that sense, the firms you are saving, mostly actually viable firms. In fact, most of the funds did go to the firms who didn't need it. That's the waste, right? But the good thing is there is no future zombification. So the final thought here is, okay, this is good news. Yes, we waste a lot of money. We didn't create a lot of zombies, right? So of the firms survived 2020 because of policy support, only 23% are zombies that survived to the end of 2021. And who are failing by the end of 2021 is 13% are zombie firms, so not that bad. So the key risk to manage moving forward is financial market panic. We need to do a lot of work, but I now working with the US regulatory Y14 data. This is the universe of the US companies. Now, finally, we can observe the financial positions of the private firms in the United States. And that data shows that actually large firms access their credit lines during COVID, like these are the airlines and all that, but small firms actually couldn't. And how that situation reverted thanks to the policy. So policy filled in for credit markets for small, medium enterprises during COVID. And then moving forward, any uncertainty about monetary policy, financial markets can change this situation. So that's something we have to watch out for. Again, just the two takeaways during COVID: policy prevented firm failures, didn't create zombies. The funds were wasted for sure, all firms who didn't need it. One of the early policy proposals I have written in actually as early as April 2020 is a negative SME tax. I thought IRS just should give a negative tax right now, later claw back as a positive profit tax. Obviously policymakers didn't listen to me, but anyway. So the thing is, we did waste a lot of funds, don't get me wrong, but not in the sense that we created zombies. It went to the firms who didn't need it. Now, the post-COVID SME fundamentals are strong. They don't need additional support here. In terms of that, we do need to dial the fiscal support back. However, the way we taper the monetary policy support, that's very important how we do it. Uncertainty and any kind of volatility in the monetary policy action that might lead to a financial market panic combined with a new variant can be the downside risk scenario. Thank you, Nicolas.
Thank you very much, Şebnem. That was superb. And I should say that your slides are already on the Peterson Institute website if you go to the financial statements page and the page for this session. So there's a lot of materials that you couldn't cover in 10 minutes in the slides, but they're available to our audience and the public. Atsi.
Thank you. And thank you, Şebnem. I echo Nicolas's comments that this is an excellent analysis and provides a lot of food for thought. So what I thought I'd do today in response in my 5 minutes is sort of really divide it into 3 parts. One is underscore some of the lessons that Şebnem's talking about and maybe supplement and complement her points with what we have learned at the rating agency at Moody's from our experience of COVID and rating corporates through COVID. Then I wanted to offer some, again, complementary data from our default analysis. So this is complementary to sort of the bankruptcy analysis that you did, Şebnem, and see how that compares to your findings. And I think there's some interesting lessons there too. And then 3, talk a little bit more about the risks going forward, the way we see them. So number 1, what are the lessons? I think the key lesson, Şebnem, is that the fiscal bailout was effective. It was effective in preventing bankruptcies to some degree that COVID would have otherwise led to. And it also, and I think this is the really important point, that it has not now created additional risk by way of bailout, which I think is an interesting one. And I'd like to maybe during the discussion talk through that a little bit more as to why that didn't happen. Why didn't more zombification happen if companies were given extra money and they, did they use it to invest in capital? What did they do with it that prevented zombification? The second point I would make sort of as supplementary to why the bailouts were effective and bankruptcies were fewer, I'd say that the banks being in good health was really important for the corporate sector during the pandemic. If you compare this to the global financial crisis and you think about how both monetary policy liquidity spreads through the economy, the banks play an important transmission role there. So if you're telling banks that you must forbear, you cannot, drive the loans that are not paid into your NPLs yet through the portion of COVID, the bank has to have a balance sheet that can take that on. And the banks being in relatively good health going into the pandemic, I think supported monetary policy transmission, in some cases regulatory policies that were put in place. And thirdly, also meant that governments were not worried about the financial sector and the lifeline. That would have meant making trade-offs, that 6 to whatever 2% that they spent on bailing out the corporate sector, they might have had to redistribute to the banking sector if the banks were in trouble. So I'd make that one point as well. The second point I'd make is, you talked about sort of the overall fiscal packages versus the targeted to the corporate packages. And I think the fiscal support for households was also important for the corporate sector. And again, in 2 ways. One, households went into the pandemic with better balance sheets in most cases, not all. But 2, the kind of consumption support I would hazard also supported the corporate sector to some degree, that households, even with high unemployment rates in countries like the US, could actually pursue consumption because they were being bailed out. So that is one on the lessons of COVID. And 2 similarities from the rated universe, and our sample is different, Şebnem, from the one that you did, but very interesting and similar results. Going into the pandemic before COVID, the global default rate for Moody's rated speculative grade corporations. So those are corporations that we don't consider investment grade. We believe that their fundamentals are on the weaker side. They're rated BA and below, was 3.6% in March 2020. When COVID hit, our models, we have a credit transition model, said, look, if high yield spreads go up to a little beyond what they were in the global financial crisis, if the unemployment rate falls to X levels, you could see that 3.6% in a worst case scenario going to between 17 and 19%, the default rate. The global default rate was what we were expecting in the worst case scenario. If there were bailouts, if the high yield spreads didn't go, then we expected, well, maybe around 10%. The actual peak default rate for Moody's rated corporates, 6.8% globally. So much lower than what we had anticipated, also much lower than the over 13% during the global financial crisis. And if you look at the GDP shock and the revenue shock, much bigger during this crisis than it was in the global financial crisis for the corporate sector, and yet a lower default rate. The difference, absolutely fiscal policy, but also monetary policy, of course. The second similarity with your data, variation in default rates by sectors. 6.8% globally, oil and gas, 24%. Retail and business, mid-teens actually, so 10 and 11% or something like that. So in the double digits for those sectors. There were sectoral differences, again, depended on the revenue shock and of course how leveraged those sectors were. Those were highly leveraged sectors going into the pandemic, but near 0% for paper and packaging. All that e-commerce, all that grocery shopping online, 0%. 0% in broadcasting, again, all that Netflix we were watching. Very low levels in electricity and sort of essential services. So I think very similar results to yours, and I just wanted to share that with the audience as well. Differences in regions, again, which you brought out, the emerging market default rate was actually lower than advanced economies going into the pandemic, partly because Moody's rates the emerging market companies that access the cross-border bond market tend to be the best and the most robust in their respective countries. So the default rates can be lower than advanced economy. But during the pandemic, that default rate was slightly higher, 7.7% at peak. So that's sort of, the summary of our data. Just quick points on the risks going forward. What are we seeing? And I think your point on liquidity is well taken, that a financial market panic, as you put it, could lead to just a liquidity tightening. And it's been abundant liquidity, particularly at the lower end of the rating scale of the corporates that we rate. That has been a boon. So the revenue shock was huge, and what companies could do was borrow their way until their revenues stabilize. And in many sectors and cases, those revenues are yet to stabilize, I would say. But what we did see is a big difference between what we call the investment grade corporate universe and the spec grade. The investment grade universe is companies are larger, they have wider competitive moats.
Spec is for speculative, right?
Sorry, spec is speculative.
Is for speculative.
Speculative. So if people are familiar with our rating scale, AAA to BAA is what we call investment grade, and the market calls investment grade, and BA and lower is what we call speculative grade. And we consider speculative grade less resilient because of fundamentals, so the fundamental to the company. Investment grade companies, our observation is that over the last, since the global financial crisis, their leverage ratios have been rising because again, liquidity has been abundant, cost of borrowing has been lower, but their size has been also rising, their profitability has also been rising, and their coverage ratios have remained steady. So despite higher debt, lower cost of borrowing. So there's some resilience. But in the speculative grade universe, which tends to be sometimes smaller companies, less competitive in their respective sectors, partly because of size, their leverage was high going into the crisis. So we were saying prior to the crisis that, look, in the companies rated BA and below, we are finding an increase in the number that are rated B1 and below. So that's at the lower end of that scale. And what this is telling us is that, look, companies that in the past could not access the corporate debt market, and that again goes to the point that you were making, the SMEs that were shut out of the corporate debt market. Some of these SMEs have grown to a size where they can access the corporate debt market, but their fundamentals are still, aligned with the weaker spec grade universe. And that there has been an increase in size of these sort of lower rated companies. So when the crisis hit, We expected that higher level of default, but it didn't happen, partly because of liquidity. So when we look ahead, we too worry about what will happen if that liquidity tightens, particularly if rates go up. And I should say that the refinancing needs, that's what we look at. So, revenue is one, revenue recovery is one. But what do these companies need to refinance? In the US, between 2022 and 2026, which is when we think, rates will probably peak sometime during that period, there's about 1.45 trillion, so 1.5 trillion to be refinanced by these companies. TMT, so the tech, media, technology sector, 20% share of that. So what do we worry about is that if you have, liquidity tightening and some sort of sector shock to some particular sectors, there could be pockets of particular risk. The last thing I'll say is in this universe, this sort of, speculative grade universe, we've seen access to credit, like you said, doesn't come just from the bond market. Some of it comes from banking, but also private credit markets have grown tremendously. It's now a 1 trillion market, which is the same as the institutional loan market. And this is not a regulated market. This is a relatively opaque market, currently very liquid, but to the extent that companies depend on this market for liquidity, and should there be some tightening, that's another risk that we're watching for. So I'll stop there because I believe I've come to the end of my 5 minutes and look forward to the Q&A.
I mean, both of you have, qualified your assessment and pointed to the risks, but even with all that, it's almost too good to be true, right? I mean, this is a very optimistic picture. Şebnem, can you give us a sense of, I guess we are all struggling with that and asking ourselves, what do we miss? And what is the next big problem that this leaves behind? How do you look at that?
I mean, so I fully agree with what Atsi said. And frankly, at the beginning, if you look at my early writings, I was writing exactly these things. I wasn't very surprised to all this. I mean, I have been working with SMEs long time, and SMEs are very different than these large corporates who borrow in the bond market. And both are going to be affected from a financial crisis, of course. A crisis like 2008, is going to rattle through across financial markets. So it doesn't matter if you borrow in bond markets or loan markets, what side of firm, everybody is just going to go under. And in a situation like that, if the monetary policy is the only game in town, which was the case in 2008 and 2010, it's all going to make sure, your banks are healthy again. That's what monetary policy does. Liquidity is in the market again, basically. And this is going to have a huge impact domestically in your own economy and also in emerging markets globally. Now, this is not a financial crisis. Nothing happened in financial markets. Monetary policy reacted way quicker than 2018, 2000, even it wasn't the financial crisis. And if you look at the capital flows to emerging markets in March, April 2020, everybody at that point were panicking. And, again, I have a light of saying that this is going to reverse immediately because, US monetary policy has a huge global footprint in emerging markets. And it reversed literally in a month. And, a country like Turkey had over 200 billion bank debt that needs to be rolled over short term. They roll over even a country like that with all these risks, right? Why? Again, this huge global liquidity. Now, here, of course, then we have to think, okay, fine, the banks are fine, the bond markets are fine, but what about the firms who cannot borrow from the banks? Even small firms, who are going to be liquidity constrained even in a normal time, let alone a shock like COVID. COVID is a shock to earnings, right? It is a shock to earnings, right? Directly. And in fact, our new work using regulatory data from Federal Reserve, Y14 data, this covers a huge set of US firms, very representative data set, shows that these companies pledge earnings and account receivable cash flow as collateral. So now you have a shock hitting the earning and hitting the collateral. What are you going to do? There is no, these companies would have been wiped off of the world. Why it didn't happen? Early on, I did say that this could have happened, but it didn't happen because fiscal policy came in town. 10 years ago, we were saying monetary policy cannot be on the show in town. Where is fiscal policy? Where is fiscal policy? Well, here's fiscal policy. It came big time. If you look at these SME programs, there are over 500 programs in our 27 countries. 500. These are SMEs. Let me define SME. SME is a firm less than 500 employee in the United States, less than 250 employee in Europe. These are the firms with less than 50 million in revenue, less than 15 million in assets. Now, generally, we kind of not look at these guys? Oh, these are we talking about restaurants here and pizza stores and all? I mean, there are very few borrowing in the bond markets. Yes, maybe that's the case, but look at how much employment they account for. They account 75% of US employment. So, I mean, I don't understand why people are surprised when Wall Street, breaking profit after profit, and then there's this huge, gains in bond markets, and then we have huge increase in unemployment. And if you don't look at these firms who account 75% of the US aggregate employment, then of course you are going to be in trouble, right? And this is what the fiscal policy did, both in terms of direct support to the firms and exactly as Atsi says, through these checks, right? Transfers to households. Now, let me clarify also one other point there. In our Jackson Hole paper, we show this clearly. So, yes, the transfers to households definitely help, but that also worsened the supply chain problem. Let's not forget that. Because originally in the pandemic, we had a negative shock both to demand and supply. Later, thanks to this huge fiscal stimulus, transfers to household, increased consumption, increased demand, you kind of explode the demand, and then, you still didn't solve the supply chain issue, then your supply chain problem is going to become much worse, right? And I also have written extensively on this. So in that sense, I think maybe at the beginning, but going back to your question, because what we missed is the fact that COVID is a very different shock. It is not an aggregate shock, it is a sectoral shock. It is going to affect different sectors differently, different countries differently, and different firms differently. So it is very different than your financial crisis scenario, right? Maybe we didn't internalize this fully. And also, I think the timing, we also missed the timing. This whole, demand normalization, monetary supply normalization, we kind of view these things in very aggregate, right? Monetary policy and aggregate, fiscal policy and aggregate. I mean, when we think about a supply shock, we think 1970s oil price shocks, very economy-wide, right? This is not the case here. So you can have one sector doing great, the other sector doing horribly, demand and supply completely moving in different directions, different sectors. This is the problem we have right now. This is the debate on inflation, right? I mean, if you have different sectors acting differently and being out of equilibrium at different times, what are you going to do in terms of, targeting these things? So it is a very different shock, very uneven shock. And I think the internalization of that in our minds and also how that interacts with policies that meant to, stimulate the aggregate economy, that maybe came a little bit later. Maybe we didn't get that at the beginning.
There are two questions from Vinay Sharma in the Q&A, and I encourage other participants to also contribute in the Q&A tool. One is about inflation and, the big inflation debate in a way. Where do we stand on this? This is not really the topic of this series, and there have been many other discussions about, team temporary versus a more hawkish views, but it would be interesting to have your view of how it links to these credit dynamics. And the other question is, the big quit, people leaving the labor force, at least in some countries, how you see that interacting with the issue of corporate credit. Maybe Şebnem first, and then I'll come to you, Atsi.
So let me clarify the question. So we want to know how inflation is going to go and what does it mean in corporate?
Basically, what I would like to know is where you stand in this debate, right? Because we've heard a lot of those, different positions from different people, and from your perspective of somebody who looks a lot at SMEs, looks a lot at credit, and has this kind of cross-jurisdiction perspective, I would be interested in your take.
Yeah, so my views are aligned with the Fed all along. I did still believe it is a transitory thing because it is happening exactly because of this problem of you have this huge, over the roof demand and a supply chain disruption. That's, of course, going to mean inflation. In its essence, that is a temporary transitory thing. Now, of course, here comes the power of transitional dynamics, right? Transitions can be long. That's exactly why now I think Fed stopped using the word transition. It is a persistent transition, right? In fact, I have a paper on this in QJE looking at the effect of capital misallocation in Europe as part of European integration. And there we look at this transition, which was basically 5 years, but led to serious disruptions in productivity because capital misallocated across firms. So these things, especially when you have this granularity in the microdata and heterogeneity, can be transitory but persistent, right? And of course, that really ties Fed's hand. They have to respond, obviously. So they cannot say, oh, okay, I will still call it transitory, even if it's taking longer than I thought. So, I think they are going to respond. They are right to respond. And they always said, if it is an issue in terms of de-anchoring the inflation expectation and turning into an inflation wage spiral, we are going to react to this. So they are going to react, but I mean, in essence, it is a transitory issue, unfortunately becoming very persistent, taking a long time to get out of this. Now,
and I assume that being with the Fed, you're also with the ECB in the European context, right?
Exactly, no, exactly, in the European context. And again, this comes back, why is Europe comes after US? Because it is also depends on the pandemic and the sectoral composition, right? We keep getting these variants. I mean, we did an actual model of this with an epidemiological model. You have these sectoral linkages, sectoral supply chains. I mean, European position and US position is different. So depending on which sector affected first, how demand and supply normalize, every country is going to experience this inflation problem in different times. And it is a very hard problem. In fact, this year's Jackson Hole meeting, there is a paper by Veronica Guerrieri and talking about what monetary policy should do when we have this extreme unevenness. Inflation coming certain sectors, but maybe not from other sectors. It differs in different parts of the world. And they talk about monetary policy targeting relative prices, right? I mean, which is, of course, not what monetary policy is designed to do. So again, this goes back to this essence of having a very uneven shock, having very different demand and supply normalization in different sectors and different countries. So, I mean, I do agree that we should react to this inflation, I mean, at some point, and that's, I think, what Fed, is going to do. But, obviously, it is actually a transitory problem becoming very persistent now. Yeah.
Atsi?
Yeah, and I'll take that a step further. One thing is, yes, we too believe that this is really a demand-supply mismatch. So just to, what is inflation? It could either be caused by demand rising much faster than supply, and that's what we're seeing, or it could be wage increases that then feed into a more permanent inflation, and that's what economists worry about. That's what monetary policy responds to. Or it could be inflation expectations, that the average household now just expects goods prices or services prices to rise and starts consuming and feeds into it. This is definitely the first bucket. It is supply-demand mismatches, and those will eventually be resolved. It's always tough when you're seeing shipping costs rising at the moment. When some of this inflation, the supply issues are not manufacturing, but it's actually food and commodity, where it's just the supply response cannot food. For instance, if you're drought in many parts of the world, you're just not going to get a supply response. Same thing with commodity, it's a slower response. So I think that is sort of well noted that this particular episode of inflation will likely abate over some part of 2022. I think the interesting thing about this episode of inflation is look what it's done to corporate margins. You've seen record margins in the rated sector, even in some of the SME sector. And what we've observed is that depending on where you are in the supply chain, companies sort of earlier in the supply chain have actually been able to pass on the costs of whatever input cost rises, they've been able to pass on. Those that are closer to the consumer are less able to pass that on. And that says something about real incomes of households, et cetera, and the amount that you can pass it on. So I do think that this has flattered corporate margins. So that abating of inflation will, yes, lead to lower rates, fears, but it will also do something to margin. So that's one point that I wanted to make. And maybe the second point, and Şebnem, I don't know if you have a view on this, but if you think about it, you announced when both of us got our PhD. So our careers have been the last 30 years, say. During that 30-year period that we've been economists or market participants, inflation has steadily gone down structurally across the world, and rates have gone down steadily. So we have a 30-year experience of things trending in one direction. And the reasons for that are very clear and structural too. You saw China enter the global trading and supply chain system. That led to sort of, some deflationary effects. You had the baby boomers reaching peak earnings capacity and saving more, demographics leading to sort of, savings, emerging market incomes rising, savings rising. So you've had inflation going down, cost of capital going down for 30 years. One thing I worry about, so this episode, I think we're all pretty clear on one page, but what if that 30-year-old cycle changes in some way? And you see a structural change in savings rate because now the people that have been saving are actually retiring and dipping into their savings, or that deflationary effect from the global supply chain being sort of more integrated comes to an end. So that's one thing, sort of long-term worry. What will that do to margins, corporate margins that have been flattered by lower labor costs? What will that do to corporate margins from the lower interest rates rising higher? So that's sort of a longer-term worry that I have. And then there was a question on, I don't know, Nicolas, was there one that we didn't answer from the audience? Besides inflation, was there something else?
There was an inflation piece and the big quit kind of labor market development piece.
Yeah, I mean, what we're seeing in the data is, yes, labor force participation has been falling, structurally again for a while now. So the big quit comes, yes, people are, there's a lot of turnover in the labor market currently, but you've seen demographics playing a role in the size of the labor force and in some cases participation of the labor force. So that, I think, again, there's a structural issue. And then the big quit is in some way a supply-demand mismatch as well in the labor market. So you're seeing that there's, at the top end, there's this demand for skilled labor that is driving wages up. And we're all seeing this in the white-collar workforce, that, recruitment levels, we were all trying to recruit and not finding people. But also at the lower end, where real wages have been very stagnant for a long time, and those are now rising at the lower end. But I would say that there's two different big quits going on. One is at the lower end of the income scale, where there's lots of other different factors going on, and the other one is compensation for skill levels. And I think, again, both are in some sense currently a supply-demand mismatch, but there are structural factors at play, particularly demographics, I would say, and aging.
I'd like to come back to SMEs and really the kind of down-to-earth realities of the corporate world. One thing that has struck me and that I find difficult to think about in quantitative terms is that we've seen a lot of business model innovation, right? Companies adapting to the new conditions of the pandemic, starting to do things differently, using the internet, restaurants, doing takeaway, that kind of thing. So kind of two related questions. How big has this been, and especially do we see an impact in terms of macro indicators or aggregate indicators of productivity? And the second point, of course, is how much has it impacted the credit dynamics, and how much of the good news in credit, absence of bankruptcies, of non-performing loans, etc., I mean relative absence, is explained by these kind of business model transformation dynamics, as opposed to just, massive injections of money from the public sector. Şebnem.
Yeah, this is a very good development. This is exactly what we want to see, right? In fact, my colleague, John Halterenger at the University of Maryland, who has been working on these issues a long time, and he gave several very recent, interesting interviews recently on this entrepreneurship, innovation, startup, business dynamics, that how COVID propelled that, right? I mean, that's great. I mean, that's exactly what we want to see, especially before COVID, when we were talking about this decline in business dynamism, and, everything is about this kind of, marginal innovations, like, okay, do, one different version of iPhone, but that's really not giving us much. So we were in kind of that type of world. To this world now, there's a lot of new innovation on that. But let me tell you what we also know historically. I mean, here again, taking the long view is very useful. These firms have always been the engine growth. SMEs, startups, entrepreneurs, like these kind of really small firms, they really grow fast, they innovate and all, but they also exit fast. Okay, so the churn is like super fast here, and that's exactly where financial markets come in, right? That's the problem, because I mean, we want these firms to be financed, but they are smaller. They are going to suffer from information asymmetries, financial frictions, default, all these things that banks are going to be hesitant lending these, and these guys cannot go and access bond markets. So that's why the other solutions are venture capitalists, fintech, and all those type of finances, which again, they are also going to be very selective. Now here, I think the thing is, we have been seeing a lot of that, but how long is going to stay? I mean, how much of these guys exit? Because traditionally, when these type of, burst of this technological innovation starts, there's also a lot of exit. I mean, the big version of this, we lived with the whole IT revolution in the 1990s. I mean, this is a development we should encourage. It should be here. We should make sure credit goes to these firms. And here comes again, and if you cannot get a fintech and VC, you are going to go to a bank. And here comes the importance of that bank regulation piece that Atsi also talked about. The reason why we didn't have the NPLs here, and remember, I showed you the numbers, is thanks to this regulation rolled out after the 2009-2010 crisis. I mean, banks are in great shape. They can actually absorb these type of losses. That should mean that they should finance more these type of firms. That's exactly what we want. If they are strong, if banks' balance sheet are strong, if regulation achieve that, then these firms should definitely get more finance. And I hope that's the world we are going to be living in the next 5 years, because that will be very good for productivity, innovation, and growth in the economy.
Yeah.
Just as I was asking this question, Julia Anderson was asking a related one, which is on digitalization, and if digital adoption is important for future firm survival. Should we include this dimension more systematically in those discussions? Do you track indicators of that? How do you view it as, a credit rating agency that is very quantitatively focused? What kind of tools do you use to assess that?
Sure. There's this cliche now that every company is a technology company. And that is certainly true. And we sort of look at it in a couple of different ways. One is at the firm level, what kind of productivity enhancements is digitalization leading to? So are you, for instance, a car company now, and we're talking automation, just needs less people on the factory floor to produce the same number of cars than it did 10 years ago. And in the next 10 years, particularly as we move towards EV, it's going to need even less. So the labor costs, which are huge for car companies, automation is cutting off a big cost. So that's one of the ways that we look at it. The second is the competitiveness advantage. And here we see this in finance particularly. And in emerging markets, for instance, you've seen, telephony. The spread of mobile phones led to financial inclusion, led to sort of, financial penetration, but it also creates a different competitive environment. Now banks are competing with mobile phone companies and fintechs that can go through the mobile phone companies. So we look at what is the sort of competitive pressure that digitalization puts on you? And we look at that. And in finance, we see this particularly acutely. Then the third way that we look at it is the macro implications of digitalization, particularly on the employment side. And data has shown that, there was this big debate about whether in advanced economies, job creation had been stagnant because of offshoring of manufacturing facilities. And a lot of studies found, including the IMF, that it wasn't offshoring as much as automation that was leading to sort of, lack of new jobs for the lower skilled. So there's a macro implication of automation as well. So productivity enhancements, good. But that has an employment impact. And then competitiveness impact can be very good, not just from the corporate perspective, but from a financial inclusion, intermediation perspective, and a systemic perspective as well. And lastly, I'd say one of the things that we're looking at more, maybe just one last thing, sorry, Nicolas, because digitalization is so important, it's cyber risk. That the more we are all on the cloud and in the on the internet, cyber risk becomes a credit risk, and that's something that we're pointing to as well.
And then we link that to geopolitics, and it's a whole different conversation. One thing I cannot resist asking is about the banking sector. So Şebnem also mentioned that at length. You told us actually that banks are in good health, but we still read those stories, for example, about Monte dei Paschi, about this bank, that bank, and all the problems that still exist, particularly in Europe. I'm not talking about the US here or indeed emerging markets, which would be a different discussion. But in the Eurozone, how much legacy problems do we still have? How do you look at the Eurozone banking sector, not just in aggregate in terms of the average ratio, but in terms of problem banks still being out there?
Yeah, no, this is exactly right, Nicolas. So Europe has, unfortunately, this culture of, kind of cycle of evergreening forbearance. Just like, so that's a little bit actually at the extreme compared to US. I mean, even emerging markets, there are emerging markets that are going to be doing better on this than Europe. So the stress testing exercise, CCAR in US, I think is a much better done exercise in terms of systemically important.
It's a Fed stress test for the largest banks, right?
Yes, exactly. Because again, the two have the same idea, right? CCAR of Fed in US, you are testing the systemically important banks. You are not going to go and after every little small town bank, but like these banks, as part of this US test, is 85% the total assets of the total banking sector in the United States. So you are really looking at the systemically important ones. Europe started this. That's the whole, EBA, European Bank Authority exercise. That's exactly have the same idea, but they don't have every single, systemically important bank. They're, of course, much more integrated. They are not one country, right? They're a union and they are trying to do the banking integration. that's their trade-off, right? I mean, that definition of systemically important banks change, and there was the legacy problem originally that they didn't.
I guess my question is not so much about this process. It's really, I mean, to put it bluntly, if Monte dei Paschi was declared failing or likely to fail, if it had to go into the resolution process, how much would we observe ripple effects? How much should we infer fragility in the rest of the system that this shock, assuming that Monte dei Paschi has a unique problem, would create propagating shocks in the rest of the system? I'm sorry to mention one bank by name, but it comes to mind.
It is not about the name of the bank actually that much. I mean, why I was talking about the process, because I think process is not being done right in Europe, but that doesn't, so in theory, you should affect ripple effects because it is not done right. And then, you have these banks that you told, okay, they are not okay. You knew already, but you just kind of are not doing your job right. So you label them, okay, so there are going to be ripple effects, theoretically. But of course, there is not going to be, in my view, because they knew what they were doing and they weren't doing it right, they are going to absorb it. I mean, again, this is going to be going through the ECB at the end of the day, as they did before. So it is going to be absorbed with the last minute brinkmanship, as they always do. So that's the frustrating part, and that's why the process is important. I mean, it is not a surprise to them. It is not something like, oh, we didn't know. Wow, we thought Montero is a very strong bank, and financial markets are going to panic. So there's going to be this surprise element. No, it's not going. That's why maybe the ripple effect is not going to be big, because they knew this is going to happen. It happened. They are going to absorb it. So that's the problem with the process. The process is not done. Yeah.
Atsi, how do you look at this?
I was just going to say very quickly that, overall, what we now know is that the socialization of risks is essential to the workings of capitalism as we know it now. And the banking system, the example that Şebnem just gave is really underscores that. So yes, there are risks, related to weaker banks. B, the expectation of the market that has been actually met each time is that authorities will step in to either sort of, bail out or at least ring fence the system from the implications of that. And that is the baseline expectation. So then the question becomes, what could change this? What could make governments behave differently? And it isn't clear that what would it be, because the cost of not doing so seems to be much bigger right now. So it would only be that if the cost of not bailing out a bank, the cost of not ring fencing was low enough that you allow this bank to fail, so that you're giving a signal on moral hazard. And I think that was part of your question, that is that a moral hazard? Yes, it is. But there you have it. The cost, the benefits of doing that seem to be greater at this point.
Nothing new under the sun. I would like to come back to the corporate dynamics. There's a question by Robert Palombi, which I will read. Do any sectors stand out as particularly vulnerable because they have large refinancing needs and are also facing structural shifts that could pose a significant challenge to their business models in the next 2 to 5 years? So not just the COVID exposure, but the financial position and the structural transformations ahead. Maybe this one is for you, Atsi.
Sure. And so one of the sectors that I pointed to was TMT, which has a large number of
telecoms.
Tech, media, and telecoms. Large refinancing needs as a share of the refinancing needs coming through. We're also pointing to retail, which faces a tough competitive environment and has. So retail tends to be lower rated in our universe. And again, their margins have been squeezed for some time. Leverage has been high. So that's a sector we're watching. Some retail has successfully pivoted to the new ways of shopping and e-commerce. Some has not, and that's where we're watching. The third sector that has the highest default rate during COVID was oil and gas, actually. And there, the structural issue is, of course, carbon transition and climate risk. And again, our baseline is that, look, oil demand will not peak for the next, roughly 7 to 10 years. Oil prices may also, stay high. I mean, they're currently very high. They'll probably fall from current levels, and they're already falling, but will not dramatically plummet in the very near future. But even if you take that into account, I think finance is already in tune with what's coming with carbon transition. So the refinancing risk of a fossil fuel company may be slightly higher, particularly at the lower end of the scale. And just one anecdote, during the pandemic, coal companies in the US did not issue at the same level as you saw other companies do. Even though they did have refinancing needs, they did not issue on the bond market to the same degree, even though liquidity was flush, partly because the deals that they were getting were not as great. And so I think that is telling you a story that finance is going to pivot before the actual transition comes.
Very interesting. We're getting close to the end. There's a question which is kind of the obvious cosmic question here. And we've said, good news for the corporate sector because there was so much fiscal intervention. But of course, that creates more debt on the sovereign balance sheet. And I already mentioned a question from Vinay Sharma on this. Paul Shiu is asking, the government debt GDP ratio increased significantly in the pandemic in most countries except Taiwan and Kuwait. That's a very short list of exceptions. It sounds systemic risk in every country increases. First, do you agree with that, sequitur? And could you comment on how this trend affects bonds issued by the private sector? Maybe Atsi first and then Şebnem.
And I used to be a sovereign analyst, so I'll say, two very quick things. Yes, average leverage has increased, and this goes to the government's socialized risks, as they do in every crisis. After every crisis, the government balance sheet does suffer because of that. The question is, how much will they grow out of this new debt that they've created? And there, if you look at the growth rates of the last 10 years since the global financial crisis, they have not allowed many governments to grow out of the debt that they created then. So the outlook is a bit gloomy from our perspective, from a sovereign risk perspective. We see a big difference between advanced economies and emerging markets in one big area, the financing costs of this debt. If you look at advanced economies, even with higher debt burden, so debt to GDP is higher, but your interest to revenue not moved much because your interest rates are so low, negative in some cases. Emerging markets, it's a different story. Financing costs are higher. And if you've looked at even this current sort of whether you call it transitory or not, inflation rates have led to higher rates in emerging markets already. Monetary policy rates have gone up. Borrowing costs for some governments, Turkey is a case in point, Turkey is actually a very different case in point.
It's special when it comes to the relation between interest rates and inflation, we know that.
But I would say that emerging markets particularly, and what we've seen is, and to follow up Paul's question with the previous question, think about African economies that are very fossil fuel reliant and have increased debt. A lot of sort of a voice of caution there is what I would say.
Yeah.
Şebnem, feel free to comment on Turkey, but also on Italy if you want, because there is a lot of interest in that dynamic. And any concluding thoughts, because we're getting close to the end.
We have 2 minutes. I fully agree with that. So this is a debate that we really need to be doing differently for advanced economies and emerging markets. It is about the debt service, right? As long as we have these super low interest rates in advanced economies, this is not the issue. Your own Olivier Blanchard, being known on this topic very well. Emerging markets, it is a different story. Definitely, it's not that they are financing their debt, domestic debt and external debt at a high rate. There's also this risk premium. I mean, in my Jackson Hole paper 2019, I show clearly that when and if U.S. monetary policy contracts, the external financing cost of emerging markets goes way upper because there's also a risk premium piece. So this is also what I have written in my June FD piece, that this is the coming taper tantrum for emerging markets, right? COVID-related temperament. So it is going to depend a lot on what US monetary policy does. So, but if it is done as in 2013 without communicating, if markets expect like something very quick and very big increase in the interest rate, it is going to be one emerging market crisis after another, unfortunately. I hope this won't happen, and then we learned our lessons in 2013. But this whole debt burden is complicating the situation a lot for emerging markets, not much for advanced economies. And your last question on Turkey and Italy, Turkey is now, unfortunately, it is a different case because they have an inflation problem, right? You have an inflation problem, you raise the rates. That's end of that. All the other stuff, exchange rate, capital flows, that stuff comes later. Your policy, if you're an inflation targeter central bank, and that's what Turkey is. That's all the emerging markets. They have one mandate. It's not like US dual mandate. One mandate, one job. You do target inflation and you control inflation. If you lose credibility on that, all bets off, right? Their target is 5. They have a 5% inflation target. Inflation is like, whatever at this point, and people stop paying attention, I guess, at this point. You don't have an independent central bank anymore. So that's unfortunately a very, very sad story. It can be reverted though. I mean, I've been said this several times. I mean, it's a country with still high growth, good fundamentals, right? The only problem is monetary policy credibility. The reason currency is sinking is monetary policy credibility, and because they completely stop inflation target and control. So it can be fixed. It can be fixed, but at this point, I don't know if it will be, but it can be. And Italy, yes, I mean, that's another issue, but that I would still see as part of the European Union. Yes, high debt, correct, much higher debt than the other advanced economies, but being part of a monetary union, I think is going to help a lot to Italy. I mean, this is a luxury.
I guess the operational question here is: can the ECB raise rate without creating a disaster in Italy? And if I hear you correctly, you say if they do it well, they can.
Yes, exactly. This is the story of whatever it takes in 2010. We saw how they can do it, before. All right.
I'm so grateful to Şebnem Kalemli-Özcan and Atsi Sheth. Again, this is a discussion that is important in its own right, and that I also view as a very interesting going full circle from the enormous uncertainty we had at the beginning of the pandemic crisis. And it's not that often that the more benign scenarios are the ones that end up materializing. So far, so good. As I mentioned, Şebnem's slides are on the Peterson Institute website on the financial statement section, so you can find them there, and there's a lot of material. Our next session will be in 2 weeks' time, Wednesday, December 22. We will also have a theme that is connecting the micro and the macro conditions, a bit like today, but specifically drilling down on what Atsi mentioned, the rates that are low or even negative, and how that affects financial sector dynamics. Ruchir Agarwal from the IMF has worked a lot on this, and all these issues of negative interest rates, reversal rates, how far can it go? And the other speaker will be Markus Brunnermeier, who is also an authority in that area, and is, of course, also at the Peterson Institute, as well as his main academic affiliation. So this is in 2 weeks' time. But again, many thanks to you, Şebnem, to you, Atsi, and to the audience for their engagement. Have a very good rest of your day.
Bye. Thank
you.